Well, I'm a baby boomer. We have seen this movie before. I've been through 5 business cycle endings. They don't end well. We know that. We've seen this movie before. So, and they all have certain tells. That optimism gets to be just out of control towards the end. And then you start seeing risk enter the marketplace, and risk has certainly entered the marketplace. And now not only do you have to worry about what's going on here in the United States with our interest rates going up, but you have to start worrying about things outside the United States. And of course, one of my concerns is one of the systemically important banks, which is Deutsche Bank, hasn't made money. They've lost money for the last 3 years, and it just laid off 10,000 people. But something happened today in China. Now, we're not paying close enough attention in China. China today entered a bear market for their Shanghai index. And that's been a really, really strong index for the last 6 or 7 years. And today it's entered into a bear market. And they went down in February and they haven't recovered. Now, that's bad enough in itself, but in China, they have a special, unique financing arrangement with the shadow banking industry in that the companies pledge their shares as collateral for loans. So if you borrowed $100 million when your stock was at 100, that's just great. And if you've enjoyed a good marketplace, it's generally strengthened your position. But if you borrowed it at 100 and now it's at 80 because the stock market's gone down 20%, well, the bank is going to have a trigger point. Somewhere along the line, they're going to say, well, we're not going to take any more risk. We want our money back. And there's going to be a margin call, and they're going to sell that stock out. And that, of course, is going to cause turmoil. It's going to be very, very, very poor for whatever the bank was, because the risk they may lose money. And, of course, the financing company, the stock company, is going to have trouble as well. But we're all interconnected. So once they start having trouble, well, you're going to see it as a domino effect, because it's not just like one stock has gone into a bear market. The whole marketplace has gone into a bear market and lost 20%. Some of them have even lost even worse. So we need to keep our eyes on that. If they go down to 4 or 5%, you're certainly going to see some margin calls, and it could be devastating margin calls. So it's a time for us to be careful. It's a time for us to be prudent. It's a time for us to talk to our spouses and say, at what point do we decide we've had enough and that we're not going to take any more risk, and that we're going to start taking some of our funds and going into cash. So I would say to you, if you had a very good run, then you need to start thinking of maybe just take the principal off the market. If you started with $300,000, then take that original $300,000 and maybe put it somewhere safe. You might consider putting it into separate asset classes, because all these asset classes don't go up and down together, and the stock and the bond market are the ones that are at most risk at this moment. Commodities and of course real estate are still decent investments, but here again they may correct a little bit, but nothing like what's going to happen in the stock and bond market. So I'm here in Maricopa County. If I can help you in any way I can, I'm officed in Scottsdale, Arizona. You'll have my number here if we can help. If you want to brainstorm, you want to ask any questions, we're here to help. Thank you so much. Bye-bye.